Hi everyone, good evening, and a warm welcome to our LLF Let's Learn Futures webinar series. We are delighted to have you here with us today. And before we get started, please confirm that you can hear my voice clearly by typing yes or share an emoticon in the chat box below so that I know everything is working well on your side. You are able to hear me clearly. So if you're able to hear me, you can type in yes in the chat box so I know that everything is working well on your side. Great, thank you very much. Our topic for today is palm oil mastery, optimizing efficiency in spread trading. This LLF webinar series is proudly brought to you by Bursa Malaysia in collaboration with our company Excellent. I'm Siwaisa. I will be the moderator for today's webinar session. We are privileged to have David Ng with us today to share with us this informative session about how you can do spread trading in the crude palm oil futures. As you know that besides trading futures outright, you can also do spread trading. Now, some of you probably may have heard about spread trading before. While for some of you, spread trading may be something foreign, maybe new to you. Therefore, our topic for today will be sharing with you about spread trading, where David will provide and elaborate on this topic in greater details. I noticed there are more people coming or just entered this webinar room. Before we begin, just another final quick sound check. Please type in 111 in the chat box or give us a thumb up to confirm that you can hear me clearly. And if needed, you can adjust your volume settings to ensure optimal sound quality. Very good. To ensure you can enjoy the smoothest and highest quality video experience on your side, I highly suggest that you turn off your video camera during the session, as this will help ensure that everyone can enjoy uninterrupted webinar session and have an optimal learning experience. Our session for today will be divided into two parts. The first part will be presented by David. Following that, we will be opening up for a Q&A session where you can ask questions related to today's webinar topic. And to ensure that we can address your questions, you can follow these two steps. You can submit your question in the Q&A section below and send them to all co-hosts. So you need to find the Q&A button here, all right? And this will allow me to directly capture your questions easily. And please note that due to the volume of messages in the chat box, it may be challenging for me to spot your questions if you do not submit your question in the Q&A box. So along the way, if you have any question, you can type your question in the Q&A box. As this LLF Let's Learn Futures webinar series is proudly brought to you by Bursa Malaysia, we have upcoming exciting topics and more to come. Every Tuesday, we will be having this LLF webinar series. We have topics that will be conducted in 3 languages, English, Malay, and Mandarin. Our panel of speakers will be sharing with you insightful knowledge and practical strategies related to futures trading. There will be more content-packed and informative topics lining up, and we will be adding to our list accordingly. So if you are interested in any topic and want to improve your knowledge and skills on futures trading, you can scan the QR code, register yourself, and make sure to add into your calendar so you don't miss any of these sessions. Besides that, we also have the LLF online workshop. This online workshop is different from the webinar series, as this LLF online workshop is specifically designed for those who are new in getting started in futures trading. In these workshops, we will be covering a full set of beginner's knowledge in futures trading. It's a step-by-step guide to enable you to kickstart your first futures contract. So each session is 3 hours. If you are still new to futures and would like to learn about futures trading, you can register yourself in this online workshop. It's entirely free and fully sponsored by Bursa Malaysia. It's limited to the first 50 online attendees, so you need to grab your seat fast. Before we begin, it's my pleasure to introduce our speaker for today, David Ng. With years of experience in the derivatives industry, David is a seasoned expert in this area, and previously he served as the head of marketing in Phillip Futures, where he led the marketing team in driving growth and development of the derivatives industry. Currently, David is a full-time proprietary trader with ExpertX, a local proprietary trading firm where he brings a wealth of knowledge and expertise to our session today, and we are thrilled to have him share his knowledge with us about spread trading. So without further ado, I'm delighted to hand over this presentation over to David. David, there you go.
And just before I start, just like to thank Excellent as well as Bursa Malaysia for inviting me today to speak on this topic. It's a very common issue that people always face. If you are new to the futures market, when it comes to most of us are very well accustomed to trading the outright contracts. You just trade on a particular month or particular contract per se. When it comes to spread trading, when it involves two different separate contracts, it becomes a little bit in a way confusing. So I think in today's session, in the next hour or so, hopefully I can address those concerns. And eventually, I think there's a couple of myths when it comes to trading the spread market. And hopefully, we can hopefully I can overcome some of the myths that is related to the spread market. And eventually, you can take on your journey to get yourself involved in spread trading. So as usual, I think just before I start, just want to put a disclaimer out. I think anything that's presented here, any opinion that's reflected is basically my own personal opinion. It doesn't reflect opinion whether it's from the exchange or whether it's from the host itself. And I think trading in the futures market, if you are new, if you're someone that never dabbled in the futures market, do take note that investing or trading in the futures market involves a lot of risk. So make sure you do talk to your brokers, get yourself informed, do watch some of the content by Excellent, which they give you a lot of educational content, before you kickstart your journey in the futures trading journey. So I think, and importantly, I think is that even if you're new to spread trading, make sure you're well accustomed to the dynamics of the market. Keep in mind, spread trading is in a way is easy to comprehend, but sometimes when markets gets very volatile and jittery, it does also affect the sentiment of the market overall. And in other words, the spread market it will get volatile as well. So I think that's important point to take note. So make sure you're well equipped before you actually embark on your journey in the futures trading journey. So here are some of the agenda that we'll be covering tonight. I think firstly is that I just want to, if you are new to spread trading, I just want to give the audience an insight into what is spread trading all about, and some of the characteristics and type of spreads that actually you'll probably be looking at whenever you're looking at spread trading. Now, I think secondly, it's also important for us to address some of the concerns or misperceptions as when it comes to surrounding spread trading. There is always the idea that spread trading is highly complex, but the truth of the matter is actually it's not. It's as simple as trading the price differential between two separate contracts. So I think that's what we're going to be addressing. And importantly, I think is that we shouldn't be fearful of how the instrument is, but ultimately, I think spread trading itself is just an instrument for you to navigate the market. It presents a lot of opportunity. So it's best that that we're able to capture those opportunities using the spread contracts. Now, I think thirdly is that if you have been trading the commodities market for quite some time, especially the CPO market, you do understand that prices of commodities usually work in seasonality. I'll probably will show you on later slides. If you've been trading commodities for quite some time, you do notice that certain commodities does display a lot of seasonal tendencies. So what I meant by seasonal tendencies is that there's usually a period where prices tend to be stronger in terms of prices, and obviously there's a period where prices tend to be weaker. Now, whether this is based on fundamentals or whatnot, but there's a pattern that we can gather. So if you're into spread trading, I think it's important for us to understand the seasonality pattern of CPO, because by that we can actually understand how are we going to place our trades by looking at periods where it's strong and periods where it's weak. Last but not least, there's always a saying that technical analysis doesn't apply into spread trading. Now, this is fairly not accurate if you just look at how technical analysis can be applied to any type of instruments. So as long as the market quotes of prices and prices moves in certain fashion, and I think that renders the technical analysis ability. So I think towards the second part of the session of the webinar, we'll be mainly covering on how we can navigate the opportunities in the spread trading market by looking at some of the trend trading strategies that we can employ whenever we look at CPO spread trading. Now, just a basic introduction of spread trading, what it's all about. Now, I think if you just look at spread itself, we are very well accustomed of looking at trading the futures market by looking at one single contract. Whether you are trading the June contract, the July contract, the August contract, it doesn't really matter. We are well accustomed of trading a single month contract. Now, when it comes to spread trading, we are looking at double, especially if you look at time calendar spread, we are looking at double months. So for example, let's say if you are looking at July, August spread CPO, you are technically looking at July and August contracts simultaneously. Now, there's obviously a price differential between both contracts, whether it's due to fundamentals or whether it's due to supply and demand balance dynamics. It's bound to have a difference. So that's what we have been trading all about when it comes to spread trading. So it's really looking at simultaneous purchase, whether it's selling or purchasing one particular commodity with opposite position in another month or another specific instruments. So that's what spread all is about. It's really looking at a price differential. So it's also known as relative value trading. That's more of a fancy term, which ultimately looking at the price differential. So you are probably taking a view whether the spread will eventually narrow or the spread eventually will widen. Now, these are all depending on a lot of factors, which we're going to delve upon later part of the webinar. But importantly, I think when it comes to spread trading, all it matters is the price differential between both different calendar months. And I think obviously, if you are someone that's more sophisticated, you can also use spread contract as an instrument, as another method for you to be loading your contracts, especially if you're holding an outright contract. You want to roll it to another further towards the month, you can actually use a calendar spread contract to do it. And I think this is commonly used by institutional, whether you are in the plantation industry or not. A lot of these institutions will prefer to use spread instruments as a way to roll their positions over to a longer period. So in a sense, spread trading could be another risk management strategy, especially if you are in the industry. And if you are really trying to have a view or try to express a view that's more longer term in nature. Now, there's three very distinct type of spreads. I think the commonly one is mainly the calendar spread, or what we call it a time spread. So calendar spread is actually very simple. If you notice that when you trade CPO market, there's various months that you can trade up to at least 2 years. So right now the active month is in July. So you can obviously, if you're doing spread, you're probably doing 2 different months. So if you are doing a July-August calendar spread, that means either you are selling July or buying July, and definitely you'll be doing the opposite in the August month. So that's time spread or calendar spread, which is very common. So I think a lot of examples that are presented here today is mainly talking about calendar spreads. Now, obviously, there's also another type of spreads which is not so common, which is what I call intermarket spread. I think one of the famous example is that if you have been trading CPO, you notice recently there is a new contract being launched. It's called the FSOI, which is mainly based on a Thailand soybean oil contract. So if you have been trading CPO market, you do notice that there's a lot of co-relationship between the CPO market and the soybean oil. So when two markets are quite interrelated, so therefore there is an opportunity when it comes to spread trading. So intermarkets relates to different markets. So here we can obviously look at CPO as well as FSOI. There's also another classic example is by looking at SCPO against FIPO. FIPO, which is a contract that's based on an East Malaysia contract. Against there's also a price differential. So intermarkets are mainly related to different markets, or it could be different instruments. Now, again, these are also one of the quite, if you are quite well versed with other markets, like if you're trading the soybean oil and you're also trading CPO, then this intermarket spread may be something that's more relevant to you. But keep in mind, when you trade different instruments, the whole dynamics of a particular instrument can differ quite rapidly. For example, if you have been trading soybean oil and you're trading CPO, obviously there's certain factors that affect both markets, but there's certain factors that's only affecting soybean oil market. And in that sense, if we don't accustomed to that, or we don't account for that, then really then we could see the spread eventually will quite widen quite rapidly. So these are the things that you really need to take note of if you're trading the intermarket spread. Now, inter-exchange is also one of the quite interesting. You can obviously you have the launch of the Malaysia FSOI contract in recent times. So when you talk about inter-exchange, you're basically talking about a similar contract but on a different exchange. So I think a classic example will be looking at FSOI, which is a new contract against a well-established contract in the Thailand market, which is the Thailand soybean oil contract. So these are different exchanges. So obviously there is, when the instruments are the same, but price are quoted differently, there's obviously an arbitrage opportunities, and that's where a lot of traders who tend to sense this arbitrage opportunities, tend to try to navigate between both markets, and obviously that relates back to inter-exchange spread. So I think the main focus in today's presentation is mainly looking at calendar spread, or what we call time spread. And by looking at that, we can try to understand what some of the opportunities that's presented whenever we're looking at different prices for different calendar months. Now, we're not going to go too much on intermarket or inter-exchange, but I think the idea is the same, that we are ultimately looking at the price differential between both different instruments or different markets. Now, here are some essential of spread trading. So whenever you say that you are buying a spread or buying calendar spread, ultimately you're expressing a view that's quite bullish in the sense that you're buying, let's say, a July-August CPO calendar spread. You're buying July and you're selling August. Having the view that probably in the month of July you will see more strength, whether it's due to demand factors or your demand and supply dynamics. You're expecting July contract to move quite rapidly, or to have more bullishness compared to August. So in that sense, you're actually buying July and selling August. So in this regards, you're buying a calendar spread. Now, the opposite position happens when you have a view that July contract is going to suffer a lot of pressure, and August looks like it's going to stabilize and it's going to be probably performing better due to seasonality and whatnot. So therefore, in this instance, you'll be shorting a calendar spread. So ultimately, it's really looking at where your view of the market is. Whether you are looking at the current condition of the market is bullish or bearish. So normally in a very bullish market, you tend to notice that those contracts that traded quite close to the current month, whether for example, right now, you are in the month of April, so May, June contracts tends to do much better compared to July, August. Reason being is because if current scenarios do warrant a more bullishness market, usually the near month contracts will move quite gradual compared to the further month contracts. So in this case, if you sense this kind of sentiment in the market, normally what you do is that you buy a calendar spread as a way to capture those opportunities. Now, so these are some of the scenarios, classic, typical scenarios where when you should be buying a calendar spread or when you should be selling a calendar spread. Now, I think this dynamics is quite interplay. Ultimately, what really determines that, what's your view of the price differential? Are you expecting that this price difference eventually will narrow or widen? Now, if you expect the price to widen, normally you should be buying or you should be quite bullish on the calendar spread. Now, if you are expecting that eventually this spread that you see in the market, it will narrow quite substantially, then eventually that you should be selling a calendar spread. So these are some of the classic typical examples of scenarios where we are looking at whether you should be buying a calendar spread or you should be selling a calendar spread. So if you just look at the definition of near month and far month, near month refers to contract that's traded quite close to where the current month is. So if you're trading CPO market, you probably contracts like May, June, July are what we consider as near months. Far month contracts are those that is further away from near months, whether it's looking at August, September onwards. So those contracts are considered far month. So whenever you see a scenario where the current month or the near month contract starts to move up, but the far month contracts are not moving, it's actually coming down. So in that sense, the market is telling you the current market is going to get very tight, which means quite bullish. So in a sense that you can buy a calendar spread to try to capitalize those sentiments. Now, there's also a scenario whereby the near month is going up, the far month is also going up in terms of prices. But the problem is that if you notice that the near month contract starts to move higher, the change is greater. For example, the near month contracts can move up a day on a daily basis up 50 points, but the far month contracts only up by 30 points. Then you notice that the spread actually get wider. So in that sense, you can sense a bullishness on the market. In that sense, also you'll be looking at a bullish calendar spread. Now, when you look at, doesn't mean is that market goes up, you should be buying calendar spread. When market goes down, you could also be looking at bullishness in a calendar spread. Now, how that works is that, no, if you in a falling prices environment where market is very bearish, obviously all contracts will start to decline in prices. The problem is that the speed of the decline. If you notice, the near month contracts are not declining as fast. In fact, the near months are only down like 20 points, but the 5 month contracts like your August or September, your October contract starts to fall more than your near month contracts. That usually signals that it's actually quite bearish towards the further months. But the 5 month contracts are still quite strong. It's not bullish, but it's just telling you that it's not dropping as fast as the 5 month contracts. So in this case, no, you should also tend to look at the bullishness of the spread because the new months are still strong. It doesn't fall as much as compared to further months. And further months is falling much faster. So these are some of the examples that now we can look at buying a particular calendar spread. Now, in a selling scenario happens is that, if you start to notice near month contract starts to weaken a lot and the 5 month contract seems to be stable or in fact inching higher. This is where you start to see spreads to get the price differential starts to get quite narrow. So in this case, you can also be selling a calendar spread, which means that the current near month is actually quite bearish. This usually happens when production starts to pick up, stock starts to increase. You tend to see a lot of selling in the front month rather than the 5 months. So in this example, these are some scenarios that you should be looking at selling a calendar spread. Now, in a downtrend scenario in the market, obviously it's all talking about relative value. So when prices, most of the contracts are falling, we really want to know what is the quantum, especially for a near month relative to the 5 months. So if the near months are falling much faster, it's telling you the market is actually very bearish currently. So you can see definitely, the spread will probably be narrowed quite substantially, or in fact even can go into negative territory. So these are the examples and sentiments that we really need to gauge whenever you look at when to execute a bullish pair on a calendar spread or a bearish pair on a calendar spread. So if the near month contracts are falling much faster than the 5 month, normally that's a sign that you should be looking at selling a calendar spread. Same goes vice versa. It's all talking about relative strength. So if the near month is not enough strength compared to the 5 month in a rising market, normally that also tells you that it's also quite bearish when it comes to calendar spread. So these are typical scenarios where you can see when you should go bullish on a particular calendar spread and when you should be bearish on a particular calendar spread. So I'm not going to go too much on the definition. I think obviously you can just read it on your own. But I think importantly, the key point is that you just need to understand where the near month contracts is in relation to the 5 month contracts. So if you notice that the near month contracts are rising rapidly, rising faster than the 5 month contracts, this is a sign that the market is quite bullish. So calendar spreads, if you tend to establish a bullish calendar spread or what we call bull spread. So in scenarios where markets are supply demand dynamics are tight, it's really pushing markets higher. These are some scenarios and examples that you should be looking at buying a particular calendar spread. So these are some of the examples that we can look at. And importantly, I think is when you look at spread contract, it's really looking at the view of your current against the further months. Whether is there's bullishness in the current or there's bearishness in the further months, because that will ultimately determine whether you should be looking to buy a calendar spread or you should be selling calendar spread. So bear spread is very much in relation to the current near month contracts. If the near month contracts doesn't seem to take off as compared to the further month contracts, that usually tells you the spread is going to hit downside, and that's where we tend to establish a bearish spread scenario. So just to give an indication, this is basically looking at June and July outright price. If you just plot both of these contracts together, you can clearly see there is a price differential between both contracts, and that's what ultimately we meant by June-July time spread or calendar spread. Now, eventually, this differential can widen or narrow. And if you notice, there's two things to observe here. First thing is that at most instances, pretty much across time, you notice that the June contract is trading above the July contract at most of the time, which means that in this type of market is what we call a backwardation market. That means it's quite a bullish scenario. When the front month contracts are very positive, it tells you that something, usually it tells you production is very tight, the stock levels are very tight. Usually that will push the front month prices higher. And eventually, when you see front month prices are not moving as much, it's probably signaling to you the market, when it hits towards the couple of months forward, probably the production scenario and the stock scenario will start to normalize. So I think that's crucial to understand if you're looking at two different contracts altogether. So eventually, when it comes to spread trading, all we matter is that what the differential between these two contracts that's in play. So I just want to touch a little bit on benefit of trading spreads. I think the key thing, one of key benefits of looking at spread is that it's a much reduced risk in terms of exposure. Now, if you do basic outright trading in terms of contract, whether you're buying July contract or selling August contract outright basis without a simultaneous opposite position, you're exposed 100%. So if the market, if you just say you buy a July contract hoping that the market is going to rally, but eventually, whether there is whether there's a news that export is coming down, and if your outright position starts to decline, then eventually you suffer losses. So that's 100% exposure to the market. Now, if you establish a spread position, that means you probably could be buying July and is selling August. You in a way your buying position will be losing money, but your short position in a way is giving you a bit of profit, and eventually this particular position could be net off, and in a sense your risk exposure is much less. Now, since the risk exposure is much less, normally the exchange margin that's given for doing spread contracts is much lower compared to doing an outright basis. So do check with your respective brokers whether what's the margins like. But in normal circumstances, spread margins usually are much lower compared to outright margins because of the nature of the risk that's being involved. Now, this is where it gets interesting. A lot of people have misconception that you can't apply technical signals when it comes to trading spread, because the nature of spread is talking about differential, and a lot of thing that matters when it comes to differential is all about fundamental analysis. Now, it's true to a certain extent, but it's not true to a certain degree. The fact of the matter is that spread is an exchange traded spread is just another instrument that you can trade off. So you can apply certain technical analysis to really look at some signals that you can actually enter or exceed a particular prices for a particular spread. So in certain regards, Little I'm just going to show you that you can actually employ technical analysis when it comes to spread trading. Now, fourth thing is actually very important. If you are trading CPO market, it's a very seasonality based. There's always a period where CPO prices tend to be stronger, and there's always a period where prices tend to be weaker. So if you can establish that kind of seasonality pattern, indirectly you can also establish a particular spread position. So you should be looking at trying to long months that is strong in terms of prices, and you should be looking at shorting months where prices tend to be weaker. So that's where you position seasonality analysis into spread trading. Now, given that it's lower margin, therefore your rate of return is higher. Keep in mind, lower margin also incorporates a higher leverage. That's where a lot of misconception where people always say that lower margin means a greater profit, but it's also vice versa. So like I mentioned, I think it's all about risk management at the end of the day when it comes to trading. But given the nature of spread trading, which is a lower risk, you're able to navigate the market much easier. Now, I think last but not least, in terms of benefits of using spread, is that if you're having a view of the market which is longer term in nature, you can, instead of you closing a particular outright position, you can actually roll that outright position using a spread contract. So I think this one you do engage with your broker on how to do it. But I think in terms of having, if you want to express a view that's longer in time frame, I think spread itself is actually a very good way to do that, to roll your positions over to a longer period. So instead of trying to close outright and re-establish another forward or another futures particular month, so you don't have to do that. You can actually use spread to do it. Now, I think one of the key benefit that's worth mentioning when you look at spread trading is all about volatility. First of all, the nature of lower risk is in terms of, because you're having a simultaneous different position, it keeps your exposure minimal. Secondly, is also when you look at spread and look at outright in terms of price movement. So what I have here, the chart on the left is basically a June outright contract. So if you just look at the ATR value is about 70. ATR stands for average true range. So the range of the day is about 70 points. You can clearly see outright trading, the daily range is 70 points. It's actually quite massive. So you know, that's the exposure you're being exposed to on a daily basis. Now, if you trade the June-July calendar spread, which is the daily range, have an ATR value of 11 points. So it gives you a much lower volatility whenever you look at the spread trading. So in that sense, you know, if you are someone that is you know, you kind of accustomed to the nature of having high volatility, you know, some maybe perhaps spread trading is something that you could consider, because the nature that the volatility of the range, the price range of a particular spread trading tends to be lower compared to the outright trading. So I think that's one of the benefit for people to actually look at when it comes to spread trading. So these are basically a contract table for all the different months that's available for you to trade. These are all outright contracts. So you know, obviously there's volume right until at least 1 year out. Obviously, if you go further than that, you know, usually the volumes tend to be thin, and that's where, you know, a lot of people would tend not to be involved. So at least, you know, fairly to say that you have very good volume right up to a year or so, and that's where you can establish your view based on the contracts that's traded. So these are all outright prices. Now, one thing I want you to take note is that if you just look at the last done prices for majority of the contract months, starting from May 2024 right until, you know, the December or even January next year, you notice one common pattern is that, you know, prices in the 5-month contracts are actually declining compared to near-month contracts. So in this market structure, we call it a backwardation market. Now, backwardation market, when you have the 5-month prices trading much higher compared to the 5-month prices, it's not to say that 5-month is going to be bearish. It's more indicative that the near-month contracts is actually very bullish. So this scenario usually happens when market in the current scenario is actually very bullish, whether it's down to fundamentals or whether it's down to external factors. But it just points to you the sentiment of the market right now is still quite bullish. Now, this curve obviously can change. It does change. There's also a period of time where you can see the near-month contracts trading much lower compared to 5-month contracts. When that happens, usually it means there is a lot of negative factors, fundamental factors that's in the market. I've seen this during the pandemic. That's where you see a lot of these near-month contracts traded at a much lower price compared to the 5-month contracts. So I think these are some of the sentiment that you need to be aware whenever you are trading the spread market. Now, this is a table for the SCPO exchange traded spread. So you can clearly see you can trade, you know, May, June, you know, June, July, August. These are all calendar time spread you can look at. So obviously, you know, if you are looking at a certain pairs, no, April and May is pretty much spot contracts. Normally, we don't trade that when it comes to the because it's close to expiry. So normally we look at the third month out or the third month active contract, which is July. So it's July, August, or even in fact you want to go further months, you can do the August, September, October, and whatnot. So there's a lot of different combinations of months that you can that's able to trade and for you to express your view. But importantly is that, you know, try to trade the exchange traded spread that's more active in terms of volume. You know, because when you go too much further out into other months, liquidity could be an issue. But I think if you trade closer to the near month contracts or the middle month contracts, that's where you can see there's a lot of liquidity, and that usually is a favorite traded calendar spread because of the volume that's available in the market. Now, so coming into some common trading myths about trading spread is that, you know, they usually say spread trading is more volatile than outright contracts. Now, this is really not the case. If you just look at, I've shown to you a couple of slides back, if you compare outright trading, the outright movement on a daily basis, you know, is much more volatile compared to spread trading. Now, not to say that, you know, the spread won't be volatile. It can be volatile, especially during period of crisis or panic. when market starts to move in very volatile fashion, spread also tend to follow that along. But if you compare to outright basis, where your exposure is much more, in that sense, the volatility of spread contract is much lesser. So I think that's one of the key benefit of looking at spread. Now, secondly, it's not easy to understand. Now, this is true to a certain degree, but it's also in certain ways it's not. Now, I think really if you just come to pinpoint the main thing about doing spread is you're really looking at the differential, the price differential between two particular months. That's all it is. Now, there is a lot of factors that goes into how the price difference can evolve. But importantly is that, if you just look at this differential and you just express a view on it, and that's all about spread trading at its core. So no, it's not so complex like looking at combinations of strategy, looking at different set of strategies that you can employ using different various months. It's not that. I think when you look at time spread itself, the calendar spread itself, it's just looking ultimately as two different contract months and how these two different contract months behave in relation to each other. And that's how we really need to understand when it comes to spread trading. Now, third thing is that the notion of you can't apply technical analysis to spread trading, I think is false. Later I'm just going to show you a couple of slides why you can actually you can simply engage technical analysis on spread trading chart, and you get quite an easy you can pinpoint to you quite an easy entry and exit level or trend in the market. Now, do keep note that I think when it comes to spread trading and compared to outright, spread trading tends to gives you a bit more trend patterns rather than patterns where it's more of a side range market. So when it comes to spread trading, it can be very trendy whenever market starts to trend. So I think that's one thing that we can establish. If you're a trend trader, spread trading is something that you should consider because the nature of spread trading can be quite trendy in certain ways and certain time. So there's also one common notion is that fundamental does not reflect the age. Now this is kind of false in the sense that if you just look at how the interplay between the different calendar months, the way the price is reflected in the different months is also trying to tell you that the fundamentals, how the fundamentals is behaving. So for example, if the near month contracts is much higher compared to far month contracts, it's telling you the fundamentals of near month is much stronger compared to far month. So in a way, I think fundamental does reflect how the behavior of a spread, and it's important if you are trading the CPO spread contract, it's important for you to also understand the dynamics of the fundamental factors when it comes to affecting the CPO prices. Now, last but not least, it has low volume. This is again false. If you look at certain pair exchange traded calendar spread pair, especially the third month, whether it's July, August, you can see the volume is really quite substantial. So there's no issue of low liquidity. You can't get out. No, those issue doesn't exist. So just to share with you, this is the average daily volume for July, August calendar spread. You notice that, obviously beginning of the year, these contracts are far month out. There's less participation. But as we get closer into July period, especially right now, July has turned third month just today, you can clearly see the volume participation will start to increase. And the daily volume will be in a circle of about 1,000 to 2,000 contracts. So that's something that is really quite liquid when it comes to trading the spread contract. Now, this is what I meant applying technical analysis. When it comes to spread trading, it's actually very trendy. So this is the July August calendar spread. You can clearly see if you plot in the two different time period moving averages, you can clearly see that if you just look at the crossovers of moving averages, this give you quite a pretty good signal for you when to go long into the spread and when to go short to the spread. So in essence, I think spread trading, when it comes to charting wise, it does show you a bit of trend, and spread tends to trend more often than compared to the outright contracts. Now, this is what if you try to understand the dynamics of the spread market, this can be quite confusing. But if you do understand the spread contracts and how it navigates, and you just plot all the different exchange traded spread that's across the board, and you just plot it on the chart, you can clearly see the dynamics that's in play is actually quite obvious. So if you just look at June, July, or July, August calendar spread since the beginning of the year, you notice that these contracts were actually doing on fairly the price differential was actually quite moderate, was doing about 50 to 60 ringgit inter-month difference. Now, as we head over to the February and March period, we start to see this big jump in these calendar spreads. It's actually mainly down to fundamentals, stronger fundamentals, which dictates the strength in the spread dynamics. But if you look at the 5-month contracts like October, November, December, January, Feb, there hardly any action. So it's important for you to pinpoint which particular calendar spread that you want to be trade. You should be trading the particular calendar spread that's having a higher volume, and the dynamics of it is actually more volatile. If you trade those on the 5-month contracts, 5-month calendar spreads, hardly there's any action. It's going to be a very range-bound market, and you don't see that much of volatility on a daily basis as compared to the Newman contracts. But this is interesting. So if you are doing in future, if you are doing CPO spread, do take some time to actually plot the different exchange traded spread prices on different contract months. You can clearly see how the dynamics has changed. So as you look at this particular table, particular chart, you can see beginning of the year, the June, July, August spread, it hardly moved because the dynamics of the market, the fundamental factors has not kicked in yet. I think once the fundamental factors starts to kick in, you can see really there's trend that's very obvious in the calendar spread, which is why spread itself usually display quite a trendy fashion as compared to outright contracts. So basically this is showing you the June, July. You can clearly see volume starts to pick up as when June or July contract starts to be more active. And usually these are, when you see high volume, these are the particular calendar spread that you should be doing. Now, in relation to outright contracts, if you just plot the price chart of a spread contract against the outright prices, you notice there's actually quite a distinct pattern. So what I have here is, as you look at the June, July calendar spread prices against the June outright prices, you notice that whenever June outright prices starts to go up, the spread also tends to go up. And when your June outright prices starts to come down, your spread will also starts to come down, which means narrowing. So there is quite a close relationship between the outright prices and also your spread prices. That's one way of looking at relationship between the outright and the spread prices. Now, I just want to emphasize a point here. Despite saying that spread is having low volatility in nature, now in normal circumstances, in normal markets, given there's no other prevailing factors that can disrupt the market, normally spread market tend to be quite there's moderate volatility in the market. They won't establish or they won't show excessive volatility. Now, obviously, when things start to change, especially when you have a panic situation like the war situation, the Ukraine issue back in 2022, you can actually see spread also tend to be very volatile. In fact, I think the ATR during those days was almost close to 30 to 40 points. Now, if you compare to outright, which is almost 100 over points, is still fairly okay. But given that, we must understand that there's certain conditions where the spread contracts also tend to display quite volatile nature, especially when there is a panic in the market. Whether it's war ensuing or whatnot. Normally, when the outright market is very volatile, it also will be something that will nature for the spread market as well. And this is something for you to take note as well. Now, this is basically plotting, the different contract months prices on the outright. You can clearly see again, the market is displaying that the 5-month contracts are trading at a much lower price compared to the Newman prices. So it's telling you that the market is actually trading on a backwardation market, which tells you the Newman contracts are much stronger. Usually that it tells you the fundamentals at the current point is still very strong. But as we head out into further month contracts, as we head out to the next couple of months, the fundamentals will start to shift to become more bearish. That's why prices in the 5-month contracts are trading much lower. Now, since we talk about month time spread, which is talking about 2 different months, it's also worth to point out that spread can also relate to intermarket, which is talking about CPO and soybean oil in certain regards. So if you just look at how these two price movement, these two particular product is, you can really establish that these two market move quite in sync. So whenever CPO prices tend to be stronger, you can also see that in the soybean oil market. Now, vice versa, if bean oil starts to weaken, it also will in certain ways affects the CPO market. Now, so I think that's pretty much on basic understanding of spread, when to establish the bullish and bearish calendar spread, and understanding the different dynamics of calendar spread. The key thing is always the benefits of trading spread. It gives you lower volatility in nature, and it gives you lower margin requirements. In a sense, it makes you more efficient in managing your risk. Now, I think going into the second part of the webinar, really looking into factors affecting palm oil prices. This is important because if you look at spread trading, it's very much driven by fundamentals. If fundamentals are strong, normally that will push prices higher. And that's how we look at interrelationship between their different contracts or different months itself. So these are some of the factors, the key factors that affect palm oil prices. Now, these are all it's not only this is not exhaustive list. The list can go on and on, but I think whatever that's stated here is some of the key major factors that actually affect palm oil prices. Now, if you just look at the main thing, it's always down to supply and demand dynamics. If you just look at the production trend of palm oil, it's actually very seasonality. That's why trading palm oil market itself is very season in nature. If you just look at from January to February, we can establish that around March to April onwards is usually the start of rising production. And that will bring us until August, September. So when you have a period of rising production, normally you will expect prices tend to be weaker. Now, from November onwards, right to January or February, you can see production tend to be weaker. This is pretty much in line with seasonal trend. Obviously, there is a period of time where it doesn't follow. It's bound to happen. But if you just look at in totality over the past decade or so, we can safely say that as we head into the middle of the year, usually rising production period for CPO, and prices tend to be weaker. And towards the year end, we can see stronger prices because the productions tend to decline. Now, I think major factor if you trade palm oil market is to always look at the stock levels. Now, if you just look at over the past couple of decades or so, we always establish the 2 million mark as something that is psychological. So anything that is above 2 million is considered bearish because there is abundant or excess stock in the country. Now, if it's anything that is below 2 million, we should be worried because that means the stock levels is actually quite low. So we've seen that back in the early parts of 2023 or even the second half of 2022. That's where we see prices, the CPO prices ready to all-time high because the stock levels at that time was only about, I think, 1.5 or 1.4 million metric ton, which is quite crucial because when you have that kind of level and stock level is actually pretty low and demand is still strong, that tells you, prices will just have to go higher. So do monitor stock levels is important whenever you are trading the CPO market. No, I'm not going to, if you just look at it, production is something that is working inverse with the price. So if you have a rising production period, don't expect prices to be strong. And you have low production period, normally you expect the price to be supported at a certain level. So this is something that we can gather if you are trading the CPO market. Now, going into the other equation, the demand side, really, export is nothing much to shout out. What's important to establish, there's no clear pattern when it comes to export. Production, that's quite clear. Stock levels also quite clear because it's quite in line in production pattern. But export seems to be slightly, it doesn't display much of a stable pattern. But what we can safely say that, as we head in towards the middle or second or the third quarter, normally the export levels tend to be a bit weaker because in view there's not much of festival demand. But as we head on towards the year end or even beginning on the first quarter, normally expect CPO export tend to do fairly well because of the festival demand. So it's actually pretty much in line with the festival season. So when you discount that, usually in the second or third quarter, normally expect CPO prices tend to be weaker because there's a sluggish export. No, I'm not going to go too much on the demand dynamics, but basically China and India is the two major importer for Malaysia palm oil. So if the inventories are high at the port, that tells you they won't demand much. So that's how we relate. So if inventories are low, that tells you they need to replenish, and that means they will demand more for palm oil. So that's the relationship they're looking at when look at the inventories at the respective importing countries. Now, ringgit is also one major factor when you look at palm oil prices. So if you look at it, whenever ringgit starts to weaken, normally that's beneficial for palm oil because when exporters or importers import palm oil, which is denominated in ringgit, if ringgit gets weaker, that means they get more bang for the buck. So if a US buyer, they definitely will demand more because ringgit gets cheaper. But obviously this relationship doesn't always hold. There's always a period of time where, despite weakness in ringgit, we should expect CPO prices to be strong. But having said that, CPO prices still come down due to other various factors. So I think this position of understanding between the ringgit and palm oil relationship, in certain times when ringgit is weaker, normally you expect CPO prices tend to be well supported. But I think that's also, you must accustom to there's certain instances where it doesn't follow this kind of relationship, and that's important for us to take note of. Now, this is another important chart if you're looking at comparing palm oil and soybean oil market. We have clearly noticed that soybean oil came down quite gradually over time. Now, this particular spread between the palm oil and bean oil spread is fairly common. If you're doing the palm oil space, you probably want to take note of soybean oil prices because the interrelationship between these two particular products. Over the years, palm oil has always been trading at a steep discount to the soybean oil market. It could be, it's for the simple fact that soybean oil, the cost of producing a soybean oil is much higher compared to the palm oil market, so therefore it's commanding at a premium. But eventually, I think there's a season where this particular premium can turn into a discount. Normally, when this thing happens, when it's a discount market where soybean oil is relatively much cheaper compared to palm oil, there's a good opportunity for you to really go long the bean oil market and short the palm oil market. Because if you just look at certain instances, especially in the discount market here, when soybean oil is much cheaper than palm oil, you notice that that instances will not last long. Eventually, the market will go back into a premium market. Now, obviously, we had a height of this premium at about $800 at the height of the Ukraine crisis, where soybean oil actually went up to as high as 80 cents. That's tremendous, and that causes the spread between the bean oil and palm oil to widen substantially. So if you are someone that is trading on the intermarket spread, you have to be careful in this kind of scenario. The spread eventually can widen quite substantially. When you see this kind of scenario, you really must be careful on holding a particular spread. Now, obviously, given time, over time, the spread will eventually narrow. The problem is that it's always a period. It's always it's determining on how long it takes. It can be months, it can be years. So that's important if you are thinking that when you see such extreme levels in spread, that's a good time for you to take opportunity, hoping that the spread will narrow. Usually that is a very dangerous trade to be in because the spread can stay high as it is due to fundamental factors, and that's where you can get caught quite easily. Now, I think the current scenario in the palm oil market is very clear. Palm oil prices is not cheap. If you just look at the chart before, if you compare with the bean oil premium, the premium is only talking on average about $100 to $150, which is the long-term average. In fact, it's actually looking at bean oil is way cheaper. So if you are a user, a palm or vegetable oil user, there's more incentive for you to really look at bean oil rather than palm oil at this point in time. Now, if you compare to other vegetable oil, again, palm oil seems to be slightly more expensive if you compare to sunflower or even soybean oil to a certain extent. So it's very crucial because if this spread of premium that palm oil has continue to linger in the market, eventually it will cause a shift in terms of demand, and that will push prices lower for the palm oil market. So be on the lookout. If you're looking at intermarket spread, we have to be very aware of what is happening on the external market as well. Now, I'm not going to go too much on weather, but weather when it comes to palm oil prices is a wild card. Definitely, if you have whether it's El Nino or La Nina, especially El Nino weather phenomenon, it's going to have impact on palm oil prices. It depends on how intense is the El Nino. If El Nino gets more intense or very intense, that usually tells you, that will have much impact on prices. Now, this is basically the seasonality of the palm oil market for at least the past decade or so. You can clearly see it's very clear. Palm oil price tend to do well towards the third and fourth quarter, even in fact the first quarter. The second and third quarter normally prices tend to be weaker. If you just look at these are all monthly candle bars, you can clearly see during the middle of the year, CPO prices tend to be weaker. So if you try to establish a particular calendar spread, whether it's putting a middle and a far month contract, you noticing that the middle contracts are weaker compared to the further month contracts, then you should be looking at selling those calendar spread rather than buying those calendar spreads because of seasonality that's in play. So if you just put it on a table, this is clearly illustrate that June, July is usually a very bad month for CPO when it comes to prices. And if you just look at it, November, December, January used to be a very strong period for CPO market. So if you are trying to establish a particular calendar spread strategy, you can use particular seasonality that's in play to establish or express a view on the calendar spread. So if you're looking at July, December, or July, November as a calendar spread, these are the periods where prices tend to be a bit weaker on a July basis. So you should be looking at shorting those calendar spreads. Then vice versa, those periods where it's stronger, you should be looking at buying those calendar spreads rather than selling those calendar spreads. So I think the last part is try to incorporate technical analysis into spread trading. Now, I think as I mentioned earlier, spread trading tends to be more trendy in nature as compared to outright. Because outright prices, you get a lot of gyration, while spread you tend to follow a bit more trend because of whether it's seasonality or whether it's fundamentals, it's more trendy in nature. So if you're a trend trader, I think spread trading is something that you should consider. Now, first thing is always to identify the trend on the market. If this particular spread trend is showing you bullishness, you should be looking at positions for you to try to buy rather than short. There's always a notion where people tend to have the habit of trying to pinpoint a reversal in the market, especially when it's a trendy market. Now, it's not to say that's not a good strategy, but it's not a good strategy to be in the first place. Trying to time the reversal in the market is always a very stressful proposition, especially when the trend is very strong. So if the trend is on the bullishness, you should be looking at where positions or entry for you to go long in the market. Now, secondly, is always to choose the calendar spread that you're looking at. So right now, July is the active month. Look at July, August, or even in fact August and September. These two particular contract months should get more volume as it becomes active. Now, trend can also be established by looking at moving averages. Moving averages tends to give you a bit more distinct way of where the trend of the market is heading. So you can do crossovers. You can imagine how the lines are crossing. So that's eventually be one of the strategy that you can use when you are trading spread contracts. Now, I'm commonly use candles when it comes to trend trading is using the Heikin Ashi. I'm a firm believer in Heikin Ashi in the sense that it's easy to use, it's easy to identify, especially using trend as a strategy. Heikin Ashi is one of the candles that can help you to distinguish whether the market is trending or not. Now, obviously, the last but not least, whenever it comes to any entry and exit, it's always easy to identify entries, but it's never easy to identify positions for it or entries to or rather levels to exit. So regardless in any trading plan that you establish, you must have a way for you to exit the market, whether it's profit or loss. If it's wrong, you should be out of the market. If it's in your favor, you should take some profit. So I think one of the best way to really establish way for you to exit the market is look at average true range, which I mentioned earlier, which is talking about the daily range of the market. So just to give you an illustration, so I just like to pinpoint, if you're a trend trader, there's two particular charts. These two charts are same instrument, the same time frame. The only difference is the type of candles that's being used. So if you're a trend trader, looking at chart A and chart B, which particular chart will you be trading? So it's quite obvious. Chart B seems to be more favored because the fact of the matter is that it tells you the color of the trend. The color of the bar signifies the color of the trend. So if you compare the chart A, which is a normal Japanese candlesticks, you tend not to see the trend quite clearly. So if you're a trend trader, Heiken actually tends to show you the trend in a more distinct fashion by the color of the bar. Now, why Heiken Ashi is very simple, because the fact that Heiken Ashi actually derives from Japanese candlesticks. There's a formula to it. I'm not going to go too much on it. You can obviously go and Google. But because of the classification of the candles, it makes your job easier. So Heiken Ashi, there's only 3 distinct patterns that you need to know. Basically, it's the color of the bar. If the color is green and the body of the green bar is white, that tells you the strength of the uptrend is strong. And obviously, if the body gets smaller and smaller, it tells you probably the uptrend strength is getting weaker. It's time for you to probably reversal is actually pretty much in place. Vice versa, if you see a red body candle, white body, that tells you the downtrend is actually very strong. Now, if you have a series of very small body and green and red side by side, that tells you the market is heading nowhere. It's quite directionless. So in this type of markets, when the market is sideways, Heiken actually tends to give you a lot of false signals, and that's where you need to be very careful. If the market is from a trending market heading into a sideways market, that usually be a cue for you to change your strategy or to employ a different strategy. So I think the difference between Heiken Ashi and Japanese candlesticks is really down to the easiness of how to identify the trend. Heiken Ashi, there's only 3 simple forms. Japanese candlesticks, there's a lot of configurations. If you read Steve Nielsen's book, there's 100 over configurations. And in a way, it's very subjective in nature. Obviously, there's software outside that caters to that able to identify pattern, but ultimately, because of the nature of the pattern itself, Japanese candlesticks still requires a little bit of subjective interpretation. And Japanese candlesticks are more of reversal patterns. If you just look at the most common configurations, they are more on reversals. Heiken actually is more of continuation. So as long as the trend continues, the color of the bar continues, the trend is still in place. So that's how the difference between Heiken Ashi and Japanese candlesticks. So these are the dynamics. So you can clearly see, if you see there's a series of green and red candle bars, which is very short body, that tells you the market is sideways. In this type of market, Heiken Ashi may give you a lot of false signals. So you should be waiting for a clearer trend signals to emerge. Like for example, usually after a sideways market, the market tends to trend. So usually the first sign is that when the green body starts to appear and the body of the candles are white, that usually be a first point of entry for you to be entering a long position in the calendar spread. Now keep in mind, these are all calendar spreads. These are not outright contracts. You can clearly see the way it behaves on the spread contracts is actually more trendy compared to the outright basis. So technically speaking, you can employ particular technical strategies to a particular spread, not necessarily just by understanding fundamentals to make your decision. You can actually look at the spread chart itself and establish your entry points accordingly. Now, this is on July-August calendar spread. You can clearly see there is a sharp sell down. Whether that means that there's a bearishness in the calendar spread happening, I think in the middle of last month. So you can see there's a lot of red Heiken Ashi bars, and the body of the bars are white. So that tells you the bearishness is actually quite intense. Until where the body candle starts to become smaller, and you start to see green bars, that usually be a point of reversal. And that, if you just look at it, when the market turns in spread, normally it can last for quite some time. So that's the difference between using Heiken Ashi and the normal Japanese candlesticks. Now, one thing to point out if you're using Heiken Ashi is that if you just look at the candle itself, you hardly see any gaps. There's no gaps that is displayed here. Usually they display the gap by the color of the candle bar. So if you are someone that's using gap trading as a strategy, you can't use Heiken Ashi. You just have to use other type of candles, or reverting back to normal Japanese candlesticks. So I think that's a bit of downside if you're using Heiken Ashi. But if you're just looking at trends, I think Heiken Ashi plays quite a crucial role. Now, I think next, using Heiken Ashi candle bars alone to make decisions is not sufficient. You can always pair it with moving average crossovers. So there's a lot of different types of moving averages. I'm going to go in detail on that due to time. But I think what commonly used is a lot of people, if you want the moving averages to reflect more of your prices, it's usually use the exponential type. The simple type tend to lag a little bit, but exponential tends to reflect the current price more. So therefore, it actually moves along with the price quite rapidly. So here's a differential between using a simple moving average, in the 20 period, and the exponential moving average on the 20 period. You can clearly see that the exponential line tends to envelope envelope the price quite closely. So if the price are turning, you can expect the EMA line is also turning. So exponential is much favored if you're looking at try to point where the price can reverse in the market. So I think moving average crossovers are quite easy. So you just pair two different time periods. One is a shorter term time period, one is a longer term time period. So in this example, you are using a 9 and 20, 9 period and 20 period. So crossovers usually happens is that when the longer term cross or the shorter term crosses above, that tells you, the market is actually heading uptrend. And if the candles are also progressively above both the lines, it's telling you the market is heading up. So in these examples, you should be looking at opportunities for you to try to go long in the market. Now, I think one of the advantages of also using moving averages is that it smooth out your price movement. So as long as you see candles are above the lines, it tells you the market is still on an uptrend. Now, vice versa, if the candle starts to go trade below both the lines, it actually tells you the market is actually on a downtrend. So it's as simple as that. Moving averages smooth out the price fluctuation, and it does tells you whether the market is trending or not. Now, I just want to incorporate another indicator, which is I think quite useful. It's called Directional Movement Index. DMI stands for short. So there's three particular lines. I'm not going to go too detail on it. The calculations are all there. Now with the advance of Google, you can obviously go and Google the derivation of mathematics behind it. But what is important is that DMI does display trend strength quite clearly. Now there's three lines in DMI. One we call it a negative DI, directional index, and one is positive DI. The black line is what we call ADX. Now the black line is more crucial. So DMI indicators are also quite similar to moving averages in the sense that whenever you see negative DI crossing above, it tells you generally the market is going to be quite bearish because the bearish momentum starts to pick up. Vice versa, if we start to see positive DI, crossing above the negative DI, market tends to be more strong because the positive momentum starts to gain strength. But what I want to highlight is the black line, the ADX, which tells you the strength of the trend. Now, if you are trading in a trend, we need to know the strength. If the strength in the uptrend rally, if the strength starts to weaken, you should be very careful. So just by judging or just by assessing the ADX line, we can roughly gauge how far can the trend go. So in this classic example here, we have a positive DI crossing above the negative DI. So normally in these instances, you can start to see the market will feel stronger. The bullish momentum will start to gain strength. And if you just look at the black line, the ADX, it also starts to turn higher, which tells you that there's a potential uptrend in place and there's strength to it. So as long as the ADX line starts to go higher, it tells you the uptrend ready, there's still momentum. So if you are holding long in the spread, you can continue to hold until there is probably there's a weakness or the ADX line starts to come down or there's a peak in the ADX line. That tells you generally the uptrend market is probably going to face exhaustion. So DMI in a sense will tell you the strength of the trend. Is useful in that regards. So if you are trading with a trend, DMI, you can incorporate DMI as part of your trading tool as well. So this is another example of using DMI on a bearish side. So clearly you can see negative DI is crossing above. Normally that tells you bullish momentum is gaining. And the ADX line starts to point higher. So that's where you need to be careful. So in this particular spread pair, you should be looking at position for you to short rather than long. Now, so I think once you establish a way for you to enter the market, it's also important, equally important or more important for us to establish a way for us to exit the market, regardless whether it's profit or loss, whether it hits your stop loss or not. You must have a strategy for you to get stop loss, to get stop out from the market if the market go against you. So I think one of the ways is that to look at ATR. So I don't go too much on ATR, but ATR generally as an indicator tool is telling you, the volatility of the day. So as long as the volatility of the market is increased, normally the ATR value will also increase. So just to show an example here, so this is basically your June-July calendar spread. The ATR value is about 11, which is on a daily period. So right now you can clearly see the bars are coming down. So that's usually be a good sign for you to try to short the market. So by having an ATR value, it helps you to employ a risk management strategy. And how we do that, normally if you look at it, normally you look at it in this example here, what we have here is that, regardless of the time frame you're looking at, ATR value will be adjusted accordingly. So here what we have is a 30 minutes time frame. You have a red Heiken SG bars that's trading below the moving averages, and you have the negative DI crossing above the positive DI with a rising ADX value. Now, this usually is a classic example for you to do a short entry on this calendar spread. So the ATR value is 2. So obviously, you can enter a short position at 55. ATR value is at 2. If you work on a reward to risk ratio, technically you're looking at 4 points profit and 2 points loss. Now, obviously, these are quite a short term, or the value on this time period is actually the ATR value is quite small. So if you want a longer ATR value or higher ATR value, look at a longer period. But it's safe to say that because the nature of spread, that the volatility of the market is much lower compared to outright. So therefore, your risk management, in a sense, that is going to be expecting a lower ATR value. So it's more manageable. So if you think that ATR value is too small, look at the longer time period. Now, so what happens next is that with 4 points in place, it's actually very easy to hit your target profit. In fact, I think the market came down. Now, a plan is a plan. Once you hit your target profit, you're out of the market. You should be looking at the next opportunity for you to re-enter the market. Whether you try to, with hindsight, it's easy to say that you should be holding until the ADX value is done, or whether the red Heiken SG bar starts to turn green. With hindsight, it's easy to say, but when you at that point in time, if you have a plan, you should just follow the plan. And obviously, there's always other opportunity. You can't be capturing the whole trend of the market. Is definitely a difficult proposition. So always make sure you have a plan in place. Stick to it. And if you have a plan for you to cut loss, if the market cuts you out, find the next best opportunity again. So that's how trading usually involves. So just an example of a trade strategy here. So you can see there's a green Heiken SG bar, and there's the positive DI is crossing above, and the ADX value starts to increase. The ATR value is 3. So normally this is a good position for you to take a long position on the calendar spread. So again, if you find it that the ATR value is small, is on the small end, try to extend your period longer. But keep in mind, when you have a high ATR value, it means that you are prepared to make sure that you are accustomed to a longer or a wider provision for loss. So if your ATR value increase to 10, you're expecting to lose 10 points. So that's how ATR works. But it gives you a gauge. So ATR, in this sense, that it helps you to manage your risk by having a value to manage your risk out in case the market go against. So that's how you can establish a particular risk strategy. So keep in mind, if the market goes more volatile, the ATR value will increase. That means your risk provision is going to get higher. So this is what happens the next few candles. In fact, I think the market dip went up, and I think finally the ADX exhausted. Again, it's very difficult for you to capture the whole trend. Just make sure that you follow a plan that is in place. So I think coming towards the end of the webinar, I just want to mention this. Regardless any strategy that you use, whether it's trend trading or mean reversion, any type of trading strategy, you must always have a way for you to track your progress. Now, as if you are doing trading for a full-time basis, it's always these tiny little details at the end of the trading session that matters the most. As a trader, we really need to gauge ourselves on how far we have react to the market and our progress in the market. Without all this information that we have on hand, it's very difficult for us to make a decision whether we are progressing or not. So all this tracking of progress is essential, and it's actually part of your trading plan. So I think I just want to end it with a quote here by Alexander Elder. I think it's very timely and it's important for us if you're thinking of becoming a trader on a full-time basis. There's always a common notion that's out there, that the goal of a successful trader is always to make money, but it's far from the truth. In fact, I think Alexander Elder points out very truthfully is that the goal of a successful trader is always to make the best trades. Once you do that, whether you make trades as according to your plan, the results are always secondary. Once you have established that in place, eventually I think the money will always be a secondary issue. So always make sure that you must have the process in place, and that's more important as compared to the results at the end of the day. So with that, I'm just going to end here. I'm just going to pass over to CY if there's any questions from the audience.
Thank you, David, for your informative sharing. I believe many of our audiences here have learned a lot about spread trading. It's now time for our Q&A session. So if you have any questions related to David's sharing session, you can simply type your questions in the Q&A box. And remember to send your question to the Q&A box so that I can easily capture your questions. While waiting for questions to come in, for those of you, if you don't have any questions, I would like you to do a small favor, is that I would like you to take a small 1 minute of your time to fill up this feedback form. Since we have already provided you an informative session today, it takes you less than 1 minute to fill up this feedback form. You can find the feedback form link in the chat box, or you can scan the QR code with your smartphone. So just take 1 quick minute to share your feedback. Will greatly help us in improving our future sessions, ensuring that we will continue to deliver valuable content that helps you enhance your learning experience. So take 1 minute to complete this form, and we will begin with the Q&A session soon. We will continue after 1 minute. So I give you 1 minute for you to complete the feedback form. Another 30 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, I appreciate that. Thank you very much. Well, for those of you who haven't finished completing the feedback form, you can continue to finish it. And let's continue with the Q&A session. And to ensure we have enough time for all questions, I will be selecting the most relevant questions from the Q&A box. And from my side, I will also restructure your questions so that it is easily understandable for everyone. And please note that due to time constraints and limitations, we may not be able to answer all of the questions. So David, are you ready for Q&A?
Yeah, sure.
Okay, so I just now earlier on when you shared about the Heiken Ashi chart, right? There is one question related to Heiken Ashi. How can we change the price chart to Heiken Ashi in the trading platform?
Okay. Thank you for the question. So I think it all depends on whether the trading platform that you're in. So whether you are a lot of the charts example that I shown earlier is actually mainly taken from Bursa Station or even TradingView. No, point to take note, if you are using TradingView as a charting platform, they don't specifically have exchange traded spread contract chart. As compared to Bursa Station, they have an exchange traded spread. So the whatever you see on TradingView is more a synthetic basis. So regardless, I think Heiken Ashi is commonly available on most trading platform. So if you do check with your broker whether they do have a Heiken Ashi that's available on their trading platform. But if you need other external resources, I think the one I just mentioned, Bursa Station or TradingView, is some examples that I've been used for whenever the charts I always use whenever I look at Heiken Ashi. So I hope that answered the question.
Okay, next question would be that what are the factors that influence the future spread trading?
Okay, yeah. So I think it's actually really down to understanding the structure of how the price curve behaves. When I mention price curve, is basically you just plot the different prices of different contract months. You can clearly see there is a curve that's happening in the market. So there's a lot of reasons for why the curve is like that, and I think majority of the reasons are actually pretty much fundamental. So if you just look at the current spread dynamics that's in the market, you notice that the June, July, or July, August spread tend to be wider compared to the August, September, or September, October. Reason being is because the current scenario in the market is still showing you there's tightness in the market. If you notice, just yesterday after the MPOB report, the stock levels is still pretty much low. It's still below the 2 million mark. So the market is still quite bullish in that sense. But things may change as we head towards the next couple of months. If you understand the seasonality, which I just showed you earlier, whether you're heading into July, August period, these are the periods where production will start rising. So if that pretty much factor into pretty much the spread itself as well. So as we head towards the further month contracts, you start to see those spreads starts to get the price differential starts to get smaller. Reason being because the fundamentals are pointing to you that production may come back and it's going to affect prices. So that's how the dynamics of fundamentals can affect the spread, and it's important for us to be aware whenever you're doing the spread market.
All right, good. One question related to a bullish spread or a bearish spread. Earlier on, you shared some of the ways to determine a bullish spread and bearish spread, right? So, can you actually, before we go into how to determine a bullish or bearish spread, can you briefly describe what is a bullish spread or even a bearish spread? What does these two terms mean?
Okay, very simple. So right now, it's just to use as a reference, July and August spread. So July and August spread is referring to July prices and August prices. So let's take an example that July and August, the spread is about 60 ringgit. Now, if you just whether you look at a chart on July, August, or whether you have a fundamental view of the market that you expect this 60 ringgit spread will eventually narrow in the next week or so. So if you expect the 60 ringgit spread to narrow, that means you're actually bearish on the spread. That is a scenario where you're looking at July prices will start to come down and August will start to come down, but July is falling faster, so the spread will narrow. So that's a scenario where you should be looking at a bearish spread scenario. Now, if on the other hand, the July August on a 60 ringgit spread, you're expecting that the July will pick up more because July right now we have the ongoing tension in Middle East, crude oil prices high. So all these are positive factors that can actually push the July prices higher. So that's a bullish spread scenario. So eventually what we are looking at is your view on the price differential between two contracts. So bullish and bearish determines on how you see the price of July and August behave in the foreseeable future. So I hope that explains scenarios where you're bullish or bearish in the spread market.
All right. With a follow-up question, are there any quick way to determine bullish or bearish spread?
Now, I think the fastest way is just look at the spread chart. So if you just look at, just pull out July, August, or August, September spread chart. Just by looking at a chart, look at the trend. Is it uptrend or downtrend? Downtrend meaning that the spread is narrowing. Which when you see a positive spread, let's say July, August is doing 60 and the chart is showing you or it's coming down, every day is coming down 60 to 55 to 50 is a downtrend spread trading chart. So that tells you there's bearishness in the market and bearishness for this spread. So that's a quick information you can gather. To understand the fundamental dynamics or why is it coming down, why is it July is coming down faster than August, it takes too much of a comprehension. Sometimes it can be confusing. So the best way is to look at the spread chart. If the spread chart is showing you there's a downtrend chart, in fact, that means the spread itself is actually quite bearish. And vice versa, if you see the spread chart, it tends to be bullish. There's a bull trend happening. Then that's usually the first information you gather. That means this particular spread pair is going to be quite bullish. So look at the spread chart. That's the first information you can gather, and that's the best information they can gather about the particular spread pair.
Okay, a few more questions. When doing spread trading, right, when we want to search for spread contract, there are so many pairs of spread contract. So which pair of spread contracts that is, that for us as a retail trader should be trading?
Okay, that's a very good question. Thank you for the question. So always look at the spread pair that has the high volume. So for example, right now, the highest volume, this outright basis is always the third month. The third month is July. So look at July spread pair. So look at July, August. Now, as we head into the next couple of weeks, the August will also get more active. So look at August, September spread pair. Now, I'm not going to say that, don't look at the 5 month contracts. As we hit further contract months, you tend to notice the volume will tend to get quite little, or sometimes there's hardly any traded volume. So it's in a way that look at the liquidity of the volume first as the first sign to see which particular spread pair that you should be trading at. So the rule of thumb is right now the third month contract is July contract, which is very active. Look at that July spread pair. So next month is going to be August, then look at the August spread pair and so on. So that's usually the first gauge for you to choose whenever you look at the spread pair is look at the volume. That usually determines which particular spread pair you should be trading.
All right, I see it's about time. We are going to take one more last question. David, can you summarize what are the benefits of doing future spread trading as compared to trading outright?
Yeah. Okay. So I hope the slides will be made available, but I mentioned 5 important points. I'm just going to list down a few key ones. I think first thing is that when you look at spread, in terms of risk exposure is much lesser. If you're doing outright, you're talking about 100% risk exposure. Spread is you're buying and selling or selling and buying. You are doing a simultaneous position, so your risk is much minimal. Secondly, I think you talk about margin requirements. Obviously, it's lower margin requirements. So in a sense that you don't have to put too much margin out or commit too much margin as compared to outright. Thirdly, the volatility of a spread contract is much lesser. If I've shown it to you in the chart, outright ATR value on a daily basis talking about 70 to 100 points. Spread hardly move that much. You're talking about 10 to 15, which is fairly okay. So that's some of the key benefits of using or whether looking at spread as compared to outright. So I think that usually be something that we're looking at in terms of benefits for doing spread.
All right, it's about time. Thank you very much, David, for answering our participants' question. And allow me to conclude today's webinar session. Once again, let me promote our upcoming webinars, especially for those of you who missed out this announcement earlier. This is LLF Let's Learn Futures webinar series. It's a series of topics where we will be conducting every Tuesday evening, same time from 8:30 p.m. until 10 p.m. There are lots of content-packed and informative topics where you will be learning some practical knowledge about futures trading from our experienced speakers. So if you would like to join any sessions, you can scan this QR code and register the topics that you would like to attend. Once you scan the QR code, you will come to this page and there will be an event calendar. So if you would like to join the upcoming sessions, you can find the LLF webinar topics on Tuesday column. You can click on it and register yourself accordingly. Besides that, we also have the LLF online workshop. This is specially designed for those of you who are new in the futures market. If you are interested about trading the futures market and would like to learn how to trade futures in detail, then this online workshop is definitely right for you. You can pick up your phone, take a picture or screenshot this page and register yourself right after this webinar ends. You can share this event with your friends and family who would like to learn futures trading. Every session will be limited to the first 50 online attendees only. So remember to register yourself in both workshops and book yourself a seat. Once you scan the QR code, you will come to this page. Again, an event calendar. You can find the online workshop on the Saturday column. There's a website in Bursa, Malaysia called Bursa Marketplace where you can find a derivatives trading simulator, DTS derivatives trading simulator. You can do paper trading and familiarize yourself on how to use a futures trading platform. You can register yourself for a risk-free trading experience. So you can give it a try, test it out so that you can learn and begin to develop interest in futures trading. Last but not least, before we end this webinar session, let me introduce you to this Bursa Academy. This Bursa Academy is a comprehensive one-stop e-learning platform where you can get all the information and knowledge about stocks, futures, and any other products that you can trade in Bursa Malaysia. You can scan the QR code on your right here, or you can Google search Bursa Academy and make sure you are able to find this correct link. And you can access to Bursa Academy for more information. All right, this comes to the end of our webinar session for today. Thank you, David, for sharing an informative session with us. And to all of you who just joined us today, thank you for your participation. We hope you found this webinar both informative and valuable. And I believe you have learned something new about spread trading and how you can incorporate this spread trading into your practice. So with that, I'm CY. I'm signing off now. Enjoy the rest of your day. Good night, goodbye, and until next time. Bye.